History has a strange way of humbling even the most confident minds. Just when investors believe that the market's fate is determined by the headlines, the quarterly earnings, or the latest geopolitical tension, there exists a force quietly at work, invisible yet powerful, shaping outcomes in ways most will never notice. The stock market stands defiant amidst uncertainty, recessions, and crises that would seem insurmountable to anyone outside the inner circle of finance. But why? How is it possible that while millions of ordinary citizens feel the weight of economic strain, the markets keep climbing, often detached from the reality of Main Street? There is a hidden engine behind the apparent chaos, a mechanism that, if understood, explains not just the resilience of stocks, but the fragility that hides beneath their seemingly permanent rise. Today we are peeling back the layers to uncover that hidden force. It begins with liquidity. Money is not just currency. It is motion. The financial system thrives on movement, on capital flowing from one corner of the globe to another with unprecedented speed. Central banks, the so-called guardians of economic stability, wield this power. They decide not only how much money circulates but also who gets access to it, and at what cost. When panic strikes, when markets tremble at the prospect of a downturn, these institutions act almost like conductors of a symphony no one else can hear. Interest rates are cut, bond buying programs are launched, emergency lending facilities open, and in a matter of days, billions, sometimes trillions, are injected to stabilize a faltering system. To the average observer, it seems almost magical. Markets recover, investors regain confidence, and the headlines shift from fear to optimism. But the reality is more mechanical, more deliberate. It is not magic. It is leverage, liquidity, and policy in action. Consider the mechanics. When a central bank buys government bonds, it is not merely swapping one piece of paper for another. It is flooding the financial system with cash, reducing yields, and making it cheaper to borrow. Corporations can refinance debt at historically low rates. Banks can lend more freely, and investors are incentivized to move from safe, low-yield assets into equities, riskier but with potential for higher returns. This creates a cycle. Liquidity fuels investment, investment boosts prices, rising prices instill confidence, and confidence ensures that liquidity keeps moving. It is a self-reinforcing system, and it is largely invisible. Unless one understands the web of transactions, the programs in place, and the sheer scale of intervention, it is easy to mistake market resilience for organic growth, when in truth, it is heavily orchestrated. But liquidity alone is only part of the story. Debt is the other, equally crucial component. Modern economies operate on borrowed capital. Governments, corporations, and even households leverage themselves to pursue growth. This may seem risky, even reckless, but in a carefully managed system, debt becomes a tool for stability. When governments increase borrowing to fund stimulus or emergency spending, it serves a dual purpose: keeping the economy functioning and ensuring that the financial markets, which are intertwined with these obligations, remain solvent. Investors understand this implicitly. Bonds, stocks, derivatives, they are all linked to the promise of repayment, the expectation that the system will not fail. In times of crisis, even when the economy slows, the accumulation of debt, strategically used, acts as a buffer. It is a paradox. Leverage, often seen as dangerous, is also what props up the market. Without it, the system would crumble under its own weight. This interplay between liquidity and debt reveals a larger truth. The market is not an isolated entity. It does not simply react to earnings reports or geopolitical news. It is embedded in a global network of policy decisions, capital flows, and institutional behavior. Every move by a central bank reverberates across borders, influencing decisions in Tokyo, London, São Paulo, and New York. When the Federal Reserve changes its policy rate, it is not just an American signal. It is a global one. Exchange rates shift. Investment portfolios are adjusted, commodities respond. The markets are alive, but not autonomously. They are alive because of the hidden hands guiding the system. Yet this orchestration is not without consequences. Artificially sustained markets can create illusions of security. Investors may become complacent, believing that the system is invincible, forgetting that behind every intervention is a limited resource: capital, credibility, and trust. Excessive reliance on liquidity can inflate asset bubbles, making the eventual correction more violent. Debt accumulation may stabilize the market in the short term, but it can leave the economy exposed in the long term. And history, as always, is a stern teacher. The crises of 1929, 2008, and the fleeting panic moments in between all demonstrate that while the market may appear resilient, the underlying forces can only sustain it for so long. There is also a geopolitical dimension to consider. Capital is global and investors are mobile. Money moves to where it is treated best, where central banks are reliable, where governments are stable, and where the returns justify the risk. A crisis in one region does not necessarily bring down global markets if another region absorbs the shock, if liquidity is shifted, or if cross-border investments are rerouted. In this sense, the market is a living organism, constantly adapting, constantly finding new pathways to survive. And yet this adaptability is orchestrated, not random. It is guided by policy, by leverage, and by a collective understanding among the elite actors who control the flow of capital. It is easy to forget that every rally, every dip, and every recovery carries a story of intervention. Behind the scenes, complex financial instruments, high-speed trading algorithms, and decades of policy decisions converge to create what appears to the public as resilience. This is not conspiracy. It is architecture. It is the design of a system built to endure shocks while maintaining confidence. And confidence, perhaps more than any other variable, is the hidden force that keeps markets alive. Without it, liquidity and debt lose their potency. The market is not just numbers on a screen. It is a reflection of collective belief in the continuity of the system. And here, somewhere between the mechanical and the psychological, lies the genius of modern finance. Central banks, regulators, and institutional investors act with precision, anticipating reactions, mitigating panic, and controlling perception. The general public rarely sees these moves, and when they do, they are often presented as discrete policies or statements, not the intricate choreography that truly sustains the market. It is a dance of capital and credibility, and it has been perfected over decades. The market stands not because it is indestructible, but because it is carefully managed, often invisibly. Now, it is crucial to understand that this is not purely altruistic or even efficient in the classical sense. The system is designed to protect the financial infrastructure, which in turn protects the elite, the banks, and those who wield influence over credit. Everyday investors, retirees, and small businesses may benefit indirectly, but they are not the primary beneficiaries. The hidden force preserves structure and confidence above all else. It ensures that the collapse of one corner does not cascade into total systemic failure, and this is why even in times of apparent chaos the market endures. As we explore this further, it becomes clear that intervention is not static. Policies evolve, tools adapt, and market participants learn. The 2008 crisis prompted a reevaluation of how central banks interact with financial institutions. The pandemic accelerated unprecedented stimulus measures, highlighting the flexibility and speed of modern policy. Each episode adds a layer of knowledge, refining the mechanisms that keep markets afloat. What may seem like randomness to the untrained eye is in reality a complex adaptive system, meticulously tuned to maintain equilibrium. And yet, even as we marvel at this orchestration, questions remain. How long can liquidity continue to prop up prices? At what point does debt become unsustainable? Can confidence be maintained indefinitely when structural weaknesses persist? These are not hypothetical musings, they are critical considerations for anyone seeking to understand the true nature of modern markets. The answers are uncertain, but what is certain is that the hidden force operates continuously, quietly, and decisively. The final chapter of our narrative is one of cautious reflection. The hidden force that keeps global markets alive is a marvel of design, intervention, and coordination. It is a testament to human ingenuity in the face of uncertainty, a mechanism that stabilizes the financial world while operating largely unseen. But with this knowledge comes responsibility. Investors must remain vigilant, informed, and aware that the visible calm of the market is underpinned by invisible pressures, complex tools, and deliberate policy. History doesn't repeat, but it sure as hell rhymes. Recognizing the patterns, understanding the interventions, and respecting the fragility beneath the surface allows us to navigate the world of finance with eyes wide open. As we conclude, remember this: the market may stand, it may rise, and it may defy expectations, but it does so not by accident. It survives through liquidity, debt, confidence, and the orchestration of invisible hands working tirelessly behind the scenes. The hidden force is real, it is powerful, and it is the reason why, against all odds, the market keeps standing. And in understanding it, we gain insight, not just into finance, but into the very architecture of modern civilization itself.